What happens if you take $10,000 and put it into the 3 best index funds at Fidelity? The answer is wild, because it depends entirely on how you build it. Using the exact same $10,000 and the exact same 3 funds, you could end up with 2 completely different results. Build it one way, and the account is projected to pay you around $2,000 every single month, for life. Build it the other way, and that same $10,000 is projected to grow into nearly $700,000. 3 funds. One for income, one for growth, and one for everything outside America. Then 2 different ways to weight them. One version is tilted for income, the other for growth, and by the end you will see exactly how each plays out. Quick but important note, this is education, not financial advice, and every number here is a projection, not a promise. Markets fall as well as rise, and you can lose money. With that said, let us meet the 3 funds. First, what is a Fidelity Index Fund? It is simply a basket of stocks that follows a fixed set of rules, with no manager trying to pick winners. Because the fund just owns whatever is in the index it tracks, the fees stay extremely low, and that is a big reason these work so well over decades. Every solid portfolio needs 3 jobs handled: income, growth, and exposure to the world outside the United States. Income is money paid to you while you hold the fund. Growth is the account getting bigger over time. International spreads your risk across the globe. Out of everything Fidelity offers, 3 funds handle those 3 jobs especially well, and those are the ones we are using. I will show you each fund, what it does, and roughly what it returns, then we build the 2 portfolios. Let us start with the one built to pay you. Fund 1 is FDVV, the Fidelity High Dividend ETF. This is the income engine of the portfolio. It holds large and mid-sized U.S. companies that pay high dividends and are expected to keep growing those payments over time. Here is the twist. Some of its biggest holdings are household name technology giants, not the sleepy utilities most people picture for dividends. A dividend is just a slice of a company's profit paid back to shareholders, usually every 3 months. The more shares you own, the bigger the payment. Roughly speaking, FDVV has carried a dividend yield around 2.8%, with healthy dividend growth and share price appreciation in the high single digits. Those figures move over time, so treat them as a snapshot, not a fixed rate. But the role is clear: this is the fund that puts cash in your pocket. Job 1, income, is handled. Now you need the account to actually grow. Fund 2 is FNCMX, the Fidelity Nasdaq Composite Index Fund. This one is built to grow the account as fast as possible. It tracks the entire Nasdaq composite, around 3,000 companies, heavily tilted toward technology and innovation. Quick clarification that trips people up. The Nasdaq is a stock exchange, not a company, and most of the world's big tech firms list there, which is why this fund is so tech-heavy. With roughly half the fund in technology, it has historically grown faster than the others, but that concentration also makes it more volatile, so it can fall harder too. Its share price appreciation has historically been the highest of the 3, in the mid-teens per year, which is exactly why it is the growth engine. But remember, that high return came with bigger swings, and past performance does not guarantee the future. More growth always means more risk. So now you have income and growth, but everything so far is American. Fund 3 is FTIX, the Fidelity Total International Index Fund, your exposure to everything outside the United States. It tracks thousands of stocks across both developed and emerging markets, basically the entire investable world that is not America. Developed markets are countries like Japan, the UK, and Germany. Emerging markets are faster-growing economies like India, Brazil, and others. International stocks have lagged U.S. stocks for over a decade, so why bother? Because you want something that does not depend entirely on America doing well. If the U.S. has a bad decade, this is the piece that can hold the floor. Diversification is insurance, not a prediction. And quietly, its dividend has been growing faster than either of the other 2 funds, which matters more than people expect. So that is the team. income, growth, and the rest of the world. But picking the funds is only half the decision. Here is the part most people completely miss. Choosing the 3 funds is not the strategy. How much you put in each one is the strategy. The same 3 funds, weighted 2 different ways, produce 2 completely different outcomes. Tilt the weights toward the income fund, and the portfolio is built to pay you a monthly check. Tilt them toward the growth fund, and the portfolio is built to grow the account as large as possible. Same $10,000 in. Same 3 funds. The weights are what decide whether you get income or a giant balance. Let us build both, starting with the version designed to pay you every month. This is the dividend-tilted portfolio. The dividend-tilted weights look like this. 50% into the international fund, 30% into the dividend fund, and 20% into the growth fund. If it seems strange that the international fund is the biggest slice of an income portfolio, here is why. Its dividend has been growing the fastest, so over time it compounds the income hardest. The dividend fund gets 30% because that is where the cash hitting your account today actually comes from. The growth fund is only 20% here. In this version, it is a small anchor that keeps the account growing without taking over. And notice, even with half an international, the US side still adds up to half the portfolio. This is balance, not abandoning America. Blended together, this mix has projected numbers of about a 2.2% yield and around 9% annual appreciation. So how is that projected to play out over time? Remember, these are projections based on historical style returns continuing, which is not guaranteed. With that said, here is the path. After year 1, the $10,000 would be worth about $11,000. Modest, nothing dramatic. After 10 years, it is projected to reach around $30,000. After 20 years, roughly $104,000. And by year 30, the account is projected to reach about $416,000. But with this portfolio, the account size is not even the headline. The headline is what it would be paying you. And that is where it gets interesting. By year 30, the dividend-tilted portfolio is projected to pay around $2,048 every single month. That is roughly $24,000 a year, projected to land whether the market is up, down, or sideways. A huge part of that comes from reinvesting. Instead of taking the dividend as cash, you use it to buy more shares. Those new shares pay their own dividends, which buy more shares, which pay even more. Over 30 years that snowball gets enormous. In this projection, nearly 4 out of every $10 of growth would come from dividends compounding on themselves. So this version is built to pay you about $400,000 in the account and a real monthly income. But it is not the biggest possible account. Now watch what happens when you flip the weights completely. The growth-tilted portfolio flips almost everything. 70% into the growth fund, 20% into the dividend fund, and only 10% international. The growth fund gets 70% because its historical appreciation has been the highest by a wide margin, and this portfolio rides that as hard as possible. The dividend fund drops to 20%. Here, income is not the priority, it is just enough to keep some in the picture. International falls to 10%. Diversification still matters, but at this weight it is a hedge, not a core piece. Be honest with yourself about this version. Leaning this hard into one tech-heavy fund means bigger potential growth, but also much bigger drops when tech struggles. Blended, this mix has a projected appreciation around 15% a year, with a much smaller dividend yield. So if the goal is the biggest possible account, here is the path. Same reminder, these are projections assuming strong historical returns continue, which they may not. Now the numbers. After year 1, about $11,500, almost identical to the other version. After 10 years, projected to reach around $42,000. The gap is opening. After 20 years, roughly $174,000. And by year 30, the account is projected to reach nearly $700,000. But here is the catch. About 98% of that growth would come from share prices rising, not from dividends. Which means the monthly income is tiny. This version is projected to pay only around $98 a month. That is the trade. A far bigger account, but almost no income. It is money on paper, not money in your pocket. So here they are, side by side. Same 3 funds, same 10,000, 30 years on the clock. The dividend version, about $416,000, paying around $2,000 a month. The growth version, nearly $700,000, paying about $98 a month. Read that again. The bigger account is projected to pay you roughly 21 times less each month than the smaller one. Now some of you are already doing the math. 4% of $700,000 is about $28,000 a year, which actually beats the dividend income. The 4% rule is a guideline that says you can withdraw about 4% of a portfolio each year in retirement. On paper, the growth account wins. But on paper and in real life are two very different things, and this next part matters more than any number so far. With the dividend portfolio, you never sell anything. The income comes from dividends being paid out, so the account itself stays whole. The shares keep working, the dividends keep paying, and the engine keeps running, in good markets and bad. With the growth portfolio, every withdrawal means selling shares to pay yourself. And if the market drops the year you retire, you are forced to sell shares at a loss just to cover your living costs. That is called sequence of returns risk, and it is one of the biggest reasons people with large accounts can still run out of money. Neither portfolio is wrong. They are simply two different bets on what you want your money to actually do for you. If you want a check that shows up no matter what, lean toward income. If you want the biggest number and can handle the swings, lean toward growth. Before you do anything though, there are some honest warnings you need to hear. Let me be straight with you, because most videos like this skip this part. Every number here is a projection built on returns continuing at historical style rates. Real markets crash, stall, and surprise everyone. You could end up with far less. That growth fund is heavily concentrated in technology. When tech booms it soars, but when tech falls it can drop 30–40% or more. That is real risk, not a footnote. These projections also assume decades of staying invested, reinvesting, and not panicking, plus they ignore taxes, which can take a real bite in a regular account. And this is the big one. I am not a financial advisor and this is not financial advice. It is one illustration to help you understand how the pieces work. Before you invest a single dollar, do your own research, understand what you are buying, and consider speaking to a qualified professional. The goal here is not to tell you what to do. It is to help you understand the trade between income and growth so you can choose for yourself. So let us pull it all together. Quick recap. 3 Fidelity funds, 1 for income, 1 for growth, 1 for international, and the weights decide everything. Tilt toward income, and the projection is a smaller account that pays you a real monthly check without selling a thing. Tilt toward growth, and the projection is a much bigger account that you would have to sell down to live on. If you want to start, the steps are simple. Open a Fidelity brokerage or retirement account, it takes minutes and has no minimum. Then search the fund tickers, decide your weights, and invest the amount you actually want to commit. Turn on automatic dividend reinvestment, add to it regularly if you can, and then leave it alone to compound. The real lesson is not which fund is best. It is that the same money, built with intention, can become income or wealth depending on your goal. Decide what you want your money to do, then build for that. If this helped, you know what to do. Keep building, and I will see you in the next one.